Welcome back, everyone. I'm Matt, along with my brother Anthony, and we are from the Pitti Group Wealth Management, and this is the Finance Things in Life. Today, we are going to be talking about risk mitigation.
Yeah, it's a big topic, especially with meme stocks.
Well, even just volatility.
Volatility, meme stocks, volatility. People looking to ride the wave. With GameStop, crypto, Nvidia. Stocks that people feel like can't lose and just go up. We're going to talk about how to, look at those investments, how to mitigate the risk that you have. Everyone thinks that these investments just continue to grow. One of the things that we like to say is bulls make money, bears make money, but pigs get slaughtered. So if you're not mitigating risk, you're going to get slaughtered out there. So we're going to talk a little bit about that today and talk about diversifying your portfolio. Don't have 100% of it in GameStop or in crypto. What else is out there? How else can we gain assets?
Yeah. The first thing that we learn as advisors or, people that are investing, the first thing they learn is diversification, right? But what is diversification?
Wooden ship. Old wooden ship. That one probably aged us too.
Right. Oh, man.
We're not reaching the Gen Zs.
Nope. So diversification, there's different categories of it. But really, asset class diversification is one of them. So you have different asset classes, whether it's large cap companies, mid-sized companies, small cap companies. You have different companies that you can invest in.
Okay, hold on. Don't lose people.
Okay.
What is a large cap? What is a mid cap? What is a small cap?
All right. So large cap companies, think your Googles, your Apples, Amazons. Mid-sized companies or maybe companies that you've heard of, but maybe they're not as big as those large companies like Google or Apple or Amazon. And then small cap companies are companies that you've probably never heard of, unless you have some tie to them or they're a local company.
Gotcha. So it's talking about the size of the company.
The size of the company, yep.
Cool.
Yep. So the first thing we're going to talk about is diversification. What is diversification?
An old wooden ship.
Yes.
Maybe you lose a few people. Those Gen Zers out there, again, we may have dated ourselves.
Yes.
Pretty sure that's diversification, is it not?
No, it's close. I mean, diversification, there's a number of different categories that you can say, including an old wooden ship. But one of them is you have different asset class diversification options. You have, stocks. You have bonds. You have real estate, maybe commodities. So you can invest your money in different asset categories, meaning those different things. You also have sector diversification. So you may have large companies, mid-sized companies, small companies that you can invest in. So think large cap companies being your Apples and Googles of the world. Your mid-sized company, maybe you've heard of the company or not. And then your small cap, you definitely probably haven't heard of the company unless you have some sort of tie or they're a local company to you. You have different sectors as far as technology. You can invest in consumer products. You can invest in energy. So a number of different things in that as well. So you want to make sure that as you're diversifying, not only are you diversifying in different asset categories, but you're also diversifying across different sectors as well. And then you can diversify by geography, right? The U.S. isn't the only country in the world that has investments or companies, so you can invest internationally in Europe or in Asia or South America, or maybe you want to invest in emerging markets, so countries that are developing at a quick rate because they may be like a third world country. So there's a number of different ways to diversify, but that's an important thing when trying to mitigate risk is diversify. You don't want to have all your eggs in one basket. You don't want to have all your eggs invested in the country of Brazil, because what happens if Brazil's economy struggles? So that's what we're trying to do when we diversify.
Now, is there a proven strategy or a way that you should be diversifying? Should I have, 10% of my portfolio in small cap and 10% in mid cap and 30% in large cap and have 15% internationally? Is there a certain makeup that you should have dependent on your strategy?
No, I mean, I don't know if there's a proven makeup, because every year investments are going to change. One thing is going to perform well, and the next year it might not perform well. So, but historically, there's different categories that might perform better. Obviously, large cap companies, there's going to be less volatility than investing in small companies, because those small companies are going to be, some of them are going to be going out of business. They might struggle in, a recession or an economy that maybe they fall out of favor, So there's different things that might play a role. So really, you got to look at all the investments that you're going to be investing in. The ones that are more conservative or less volatile, you might be more heavily weighted in those than you would small cap or emerging markets, for example. But there isn't a set example or lineup that you should have. And then it also comes down to the investor themselves. If you're more aggressive, you might have a little bit more weighting in those aggressive or volatile investments. If you're conservative or retired, maybe you don't want to have that volatility in your portfolio. So,
makes sense. So I would imagine with different asset allocation or different portfolio makeups, they're going to react differently in different market conditions. Say you're in a recession, or we're in kind of a lull economically, certain things are going to perform better. So is there a way that we can, we can. Tell me a little bit about how we can look at a portfolio and, stress test it.
Yeah. I mean, there's a number of different things that, you can look at. What's the famous disclosure that you have at the end of, every financial commercial is, past performance isn't indicative of future results, right? So you can kind of look at what's happened in the past, and you can plan for that, but you can't really say for sure this is what's going to happen if we go into a recession.
Right.
So and that's kind of where we do a callback to diversifying. That's where it's going to come into play, because every investment is going to act a little differently in different scenarios. But typically what we do with our portfolios, as you know, is we have our own models that we manage, and we diversify within those models. We have a mix of stocks, bonds, ETFs, mutual funds, and so when we diversify, we're using the investments that we feel are the best fit for our clients, and depending on their risk tolerance, we'll invest differently across the board. But what we typically do on a quarterly basis is we reach out to third-party investment companies, and they're gonna give us their thoughts and feedback on our portfolio and what their research is saying. Maybe they think interest rates are going to rise, or maybe interest rates are going to fall, and so we can kind of gauge as far as what our beliefs are and what they are, and if they're different, is there something differently we should be doing?
Mm-hmm. Mm-hmm. Yeah, that makes sense. Yeah, clients love knowing that we have these resources of these, larger companies like a Goldman Sachs or a First Trust, for example, where we can rely on them and say, hey, take a look at our portfolio and let us know how we compare to like industry standards or other advisors in the area, maybe how their portfolios are set up, or let us know what your analysts are saying if we're too heavy in a certain allocation, or our short-term bonds are going to be too heavy. It's nice being able to lean on a company like that and say, hey, I know this is what we're telling you to put in your portfolio, or what we have in our portfolio, but this is the research saying why. This is the research of this billion-dollar company saying, yes, what they're saying is backed up by all of this information.
Yeah.
So it's nice to have that leverage as well, especially in a local shop like ours.
Yeah. Yeah. I mean, obviously, we're going to do our best as far as the diversification and choosing different asset classes, categories. We're not always going to get it right, but that's why, we can lean on some of these other investment firms and get their perspective. And the thing is there's been times where these firms will come back and say everything looks great. From our analysis, there isn't any recommendations that we have for you. But there might be times where there are, and if we don't necessarily agree, we can always say, okay, we're going to see another third party and get their take as far as what they see in the market over the next 6 months, 12 months, and so on. So, our portfolio is always, it's a dynamic portfolio. So the allocation isn't a set allocation where you have X amount in stocks and X amount in bonds and X amount in cash. It's dynamic and fluid, meaning as the market changes, we can adjust it to make sure that we feel that we're invested properly.
Yeah. Yeah, and the nice thing about being RIA as well is when we're getting these investment suggestions, we're not getting commissions on adding these to our portfolio. When we're getting these suggestions, we're seeing if it's a best fit for our clients, and if we feel that it is, then we'll implement it. So we're getting a lot of different strategies from these companies saying, have you thought about this particular investment? Have you considered something like this for your portfolio? And we feel like it's a good fit for our clients, then we'll add it. But, we're not getting compensated for this. It's just strictly for the best interest of the client.
So, yeah, and to kind of go back a little bit. So RIA, Registered Investment Advisor, and essentially what that means is we have to act as a fiduciary. We are fiduciaries for our clients, meaning we have to put our clients' best interest before our own. So that's what it means to be an RIA, or Registered Investment Advisor.
Yeah, you would think that everyone would act in the best interest of the client, but sometimes it doesn't happen.
Right.
So, for instance, with the market volatility lately, a lot of people may want to sell out of an investment because the markets has a downturn. We've talked previously in another podcast about having a long-term strategy for your portfolio. So when you have these swings in the market, that you're not getting too emotional, because money is a very emotional thing. If I'm working for 40 years, working hard for my money, and now I'm losing 5-10% in a market downturn, that can create a lot of emotions. So making sure that you're able to kind of take that side out, or at least be able to understand that you have a strategy, is a huge part in avoiding those drastic mistakes that you can have.
Yeah, I think the clients that we work with, find it peace of mind that we're managing their assets. That we're constantly monitoring the investments. We're making investment decisions as there's changes within the marketplace, because they don't want to focus on that. They
live your life.
They're
enjoy
either
the
retired
beach,
or maybe they have a family or etc. And the last thing they want to do is follow the markets and make decisions on what they should be investing in or shouldn't be investing in. That's what they kind of pay us to do. So when we are monitoring their investments and making those decisions, we're making those decisions that makes the most sense for them and their portfolio long term, and we're not trying to just find an investment that's going to make money overnight. We're looking at a long-term investment horizon.
It's a marathon,
right,
not a sprint.
Not a sprint. That's one of our quotes. I don't know about the whole greedy pig, but
it's one that I've heard. It just stuck with me.
No, I heard that one when I first started in the business almost 20 years ago. And what it was is, one thing about pigs is they always get slaughtered. So when you're investing, you don't want to be greedy.
Yep.
So
times like this, wipe your portfolio right out.
Yeah. So kind of getting back to, the investments and having that plan in place, having that long-term goal or that long-term vision can also help, take that emotional aspect out of it. Knowing that the accounts are, your accounts are going to go up, they're going to go down, they might move sideways for a period of time, but you don't want to make an emotional decision when investing, because that's where it's going to hurt you the most.
100%. The markets are always going to be volatile, just depending on how volatile. The key is just to honestly don't look.
Sometimes that's
just don't look.
Yeah. We have a range of clients, the clients that look every day, and we have the clients that will go months without looking. And so, everyone's different. Everyone can, stomach volatility a little different. So
100%. Yeah. One of the things that we've implemented based on some of this, what kind of leads into some of that market volatility, is something we call buffered ETFs.
Yeah.
It's a little bit, I would guess you could say, you get a little bit of both, best of both worlds.
Yeah.
You get to participate in the market, but you get a little bit of assurance as well. Why don't you talk about that a little bit?
Yeah, so buffered ETFs, I'll kind of just do a general oversight or overview of what they are. A buffered ETF is an investment that you can purchase or be invested in that you can participate in the market, but it doesn't have to be, the S&P 500. You can do NASDAQ, which is more tech related. You could do international. You could do crypto. But the one we'll talk about is kind of the traditional buffered ETF. It's generally like a 1-year holding period is how you should look at it. You can buy it any time. You can sell it any time, but the parameters that they use is based on a 1-year period. So recently, the one for April, it had an 18% cap, and then it had the buffer on the downside. So what that means is, over the next 12 months, if the S&P 500, it offers a 10% buffer. So if the S&P 500 was down 7% over the next 12 months, in that 1-year time period, you would be down 0. Over that course of the year, if it's down 12, then you would be down 2. So it protects you that first 10% on the downside. On the upside, it has, right now, I think the April one had like an 18% cap on the upside. So
pretty good cap.
It's 1-for-1 on the downside, 1-for-1 on the upside. So over the next 12 months, if the S&P is up 7, you'll be up 7. If it's up 27, you're going to hit that cap of 18 and lock in there. So it's a way that we found reduces volatility, especially on the downsides. They also have quarterly buffers as well, so the investment time horizon isn't as long. But it's definitely a way that you can participate in the market, but protect your downside, especially,
Yeah, such a fun conversation having, introducing this to someone who's never heard of it. It's like, what if I could tell you,
right,
you could participate in the S&P 500, and if it drops 10% over the course of the year, you lose nothing. Like that's a cool conversation to have.
Right.
And they also have quarterly ones. So if you don't want to do the year, you can set up quarterly. Obviously, it's the percentages are a bit different as far as your protection-wise. But they've got some flexibility as far as the time horizon for these investments as well.
Yeah. Yeah, and like I said, you can kind of diversify your portfolio. That's how we have them added into ours, whether it's, just a piece of the equity exposure, or maybe it's lumped in as an alternative. But you can diversify as far as, like I said, the S&P 500, tech, crypto. So there's a number of different ways to kind of use these buffered ETFs. They're becoming more and more popular. They're not available everywhere.
Mm-hmm.
Depending on where you have your investments held with a broker dealer or investment firm, maybe they offer them or maybe they don't. But they are becoming more and more popular.
Some bragging rights at the country club.
Yeah.
Jim's portfolio is down quite a bit, and you can say, actually, I'm not down that much.
Right. Yeah. It's,
thanks for this investment that maybe you don't have.
Right. Yeah. The other thing, they're becoming like so popular that I think there's colleges, so endowments are starting to use them. So I read an article yesterday. One of a large endowment is getting away from the hedge fund that they use, and
Wow.
they're now using buffered ETFs as an investment option.
Very cool. If anyone has questions on their allocation, diversification, if they're diversified enough, obviously you can reach out to us. We're happy to do a review of your portfolio, whether it be a 401k, 403b, IRA, whatever it might be. We're happy to go over that, make sure you're diversified to meet those financial goals that you have, and make sure that they align properly. So if maybe you don't know, again, no dumb questions. You don't know what you don't know. Feel free to reach out. We'd be happy to do that for you.
Yeah. I think especially right now with the volatility in the market, it's probably prudent that you review your investments, make sure that you're still on track, make sure that you're invested properly, because you might have a situation where maybe it makes sense to reevaluate and make some changes. Maybe it's a good time for you to rebalance and maybe buy into this dip that we have in the market. So more than happy to kind of answer anyone's questions, and hopefully we may have kind of answered some of your questions here today, and or maybe now you have more questions.
May have more questions, yeah.
maybe
Wait a second.
Right. But we appreciate everyone tuning in. Like I said before, any other questions that you have or any other topics you want us to discuss, feel free to send them in. We're more than happy to kind of go over them, and hopefully eventually maybe do another podcast where we can answer those for you.
Yeah.
So
appreciate it.
you guys tuning in. Thank you.